Hi everyone, this is Jason Burack of Wall Street for Main Street, back for another commentary on the markets. Today, I would like to talk about the almost year-long correction and then consolidation in gold, silver, and your precious metal mining shares, and my opinion of what will signal the consolidation is over. This has been a long and painful consolidation for many of us in our portfolios, but this is one losing battle in a long war. Gold and silver's fundamentals as real, sound money are still clearly winning the war against paper fiat currencies. Until we get some kind of major news with the Federal Reserve or another larger central bank announcing another round of stimulus, debt monetization, or buying lots of toxic assets off a large zombie bank's balance sheet, it appears to me that gold is stuck in a trading range or consolidation zone from the high 1500s to the mid to high 1600s. We could still go sideways for months until there is another major catalyst, like the Fed having to increase a long-term U.S. Treasury buying program when Operation Twist ends in June, or if we get a collapse from a European country like Spain, Portugal, or France, and the Federal Reserve has to come in with a backdoor bailout through the ECB of one or more of these European countries. Japan is also in a lot of trouble and has a lot of fundamental problems wrong with its government spending and government finances, its population demographics, and the fact that Japan no longer has access to cheap energy in a country with no real natural resources of its own. Because of the inherent leverage in miners, both to the upside and to the downside on moves in precious metals prices, miners, with a few exceptions of companies that have actually done well in these last 6 to 8 months, have experienced an even more painful correction followed by consolidation than the one bullion has had. Smart management teams at producers with strong cash flows who can control their production costs should be taking advantage of this correction and buying up cheap, accretive assets or deposits with sound project economics less than 2 years away from production. Right now, I would say the best deals in the industry and the real low-hanging fruit that more production companies should be plucking is the junior and mid-tier producers with production problems who cannot operate a mine they brought online at a profit or who are not hitting their production guidance and projected earnings numbers. Premiums for buyouts of these types of companies are small or non-existent, so they are definitely low-hanging fruit because they add immediate cash flow to the bottom line. Prudent companies like Pan American Silver, First Majestic Silver, and Aurico Gold have already done accretive acquisitions buying extremely discounted production and reserves of companies and mines where the mine can be optimized or expanded easily compared to bringing a very large and expensive greenfield project with 9 or 10 figures of capex and years of construction online. In other words, it's smarter for management teams to buy a company and mine already producing since valuations are so cheap rather than risking billions to bring online a new deposit in a new area where it could be years before cash flow. I am very surprised more production companies with cash flow have not followed the lead of Pan American Silver's acquisition of Minefinders and First Majestic Silver's buying of Silvermex. It could be because share prices are unbelievably low, along with management sentiment and investor sentiment in the sector. In fact, if you talk to longtime veterans of the mining sector, they will tell you sentiment is worse than it was in 2008. Precious metal miners have underperformed bullion by more than 2 standard deviations, despite the fact that for many gold and silver production companies that have been producing for a number of years, the companies have never generated more in revenues and profits in their entire history. Despite a run-up in oil and energy prices, profit margins and operating cash flow for many gold and silver producers are also still at record levels. So, why are share prices not responding accordingly to the underlying strength of these producing miners' underlying businesses? A large part of the reason why share prices have underperformed bullion so drastically has to do with the fact that the majority of Wall Street, regular value investors, and other hedge funds, institutions, and other controllers of large pools of capital still have little or no exposure to even the best fundamentally sound gold and silver companies. The more regular and mainstream money managers of Wall Street have a very negative perception of mining stocks. Some of the perception is deserved and some is not. Many larger mining stocks have not done a good job getting great returns on their capital, nor have they created shareholder value for decades. Share dilution has also been a rampant problem in the industry. For the industry and for share price to go much higher, mining companies are going to have to convince more mainstream money managers and other larger holders of capital that they can do a much better job creating shareholder value, paying out dividends if the company has larger increases in profits, and getting sound double-digit returns on all of their invested capital. The gold and silver industry has not done that since the 1970s on a consistent basis, and gold and silver companies will have to show with their actions that they are capable of doing all of these things on a consistent basis before more conventional Warren Buffett style value investors and regular Wall Street money managers start adding gold and silver stocks in significant quantities and are also willing to hold the shares for a number of years. Flow of funds into the sector, which increased rapidly in 2010 and for part of 2011, has done a complete 180, and now many billions worth of money has flown out of mining shares. A lot of that money was the so-called hot money, momentum players, and not buy and hold long-term value investors. For those of you not familiar with these funds, they are the trend traders and high-frequency algorithm traders controlling many billions of dollars and moving very large pools of capital in and out of positions. Some of those funds consider a long position holding a stock for at most 11 seconds. So what signals should we be looking for that the precious metal mining shares are done consolidating and are ready to move higher? Besides looking at paper spot prices, I would suggest GoldSeek Radio listeners to spend more time watching the options action on the GLD, SLV, GDX, GDXJ, SIL, and the individual stocks of larger precious metal miners listed on major exchanges that have options to trade on their underlying common shares. The next big moves in gold and silver shares will be preceded by very large open interest increases and spikes in volume on calls on the mining stocks and the indices I just told you about. So, as part of your research, monitor open interest increases in key gold and silver companies along with volume spikes for out-of-the-money calls, and monitor the time frame traders are buying the calls for. I have already been monitoring this situation, and it appears beneath the surface the larger contrarian investors and traders who manage a lot of capital and who use options extensively in their portfolios have been building large options positions with out-of-the-money calls, betting the mining shares turn around before the January 2013 expiration date. If you have thoughts of your own on when gold and silver will break out, please share them with me and my team over at the main Wall Street for Main Street website at http://www.wallstformainst.com.